Hello everybody, this is Aman. In this video, I will talk about European bond market. So let's get started without wasting any time. The lowest point. During COVID-19, the European and US bond market hit their lowest yields ever due to ultra loose monetary policies of the major central banks, including the ECB, means European Central Bank, and Federal Reserve. That made bonds very unattractive for investors to invest in. For instance, US 10-year bond yield hit 0.318%, and many countries in Europe also hit their lowest point ever. And even some of them started trading in negative for the first time, such as France 10-year bond. See, you can see here on the screen. Therefore, only the extreme risk averse or those under a mandatory obligation of investing in European markets were investing in European bonds. However, the European bond market is one of the biggest bond markets in the world, following the US and China. Next point, the recession. There is a widening acceptance that we are going to be seeing Germany in particular, but also the Eurozone heading into recession in the first quarter of next year. StoneX strategist Mr. Fiona said. There are many recessionary forces here, such as double-digit inflation figures, the Ukraine and Russia war, the energy crisis, and decreasing consumer confidence, etc. In addition to that, M2 money supply growth is about to turn negative year over year for the first time in history. Therefore, these difficulties are forcing governments to spend big to protect consumers and businesses, meaning more bond supply will hit the market in the coming months, and that can lead to a rise in bond yields. Next, what the yield is telling. There is some points that you should know before investing in bonds. First, although the nominal rate is looking very attractive due to the rate hikes, but the real rate of interest on bonds is negative. For example, the UK 10-year bond yield is 3.6% and inflation figure is 10.7%. So real rate of interest is negative 7.1%. And in Eurozone, the inflation is at 10.1% with 4.3 of average 10-year yield. Means rate of interest is negative 5.8%. Second, the current yields in the US and Europe are not reflecting the terminal rates of the Fed, ECB, and Bank of England. There can be two reasons for that. First can be that central banks will not raise the fund rates because of slowdown in the expected inflation, and the second can be the recession worries all over the Europe and US, which is reflecting in the inverted bond yield. Means 2-year bond yields are higher than the 10-year bond yield. For instance, the negative spread is 55 basis points in the USA and 9 basis point in the UK and 20 basis point in Germany. The last time it was happened during the 2008 financial crisis. So, what should an investor do? The European bond market is considered to be the safest investment destination if we exclude a few countries such as Greece. There are many investors who are considering bonds a good investment now because equity is not looking attractive enough as the major equity indices around the world in the red since the beginning of the year. On top of that, expected to give a very low returns in the next year. Meanwhile, interest rates on bonds have been rising and attracting investors to invest due to rate hikes. Therefore, there is a strong reason for investing in European bonds, especially the one issued in larger European economies such as Germany, France, and the UK, etc. The only thing to be mindful of is that interest rates are going to go up even more, probably changing course somewhere in the middle of next year, 2023. So, if one wants to time their investments, they may wait for another 3 months. And if someone wants to average down their investments over a period of time, starting now is not bad. So, thank you so much for listening me.